Good evening. So we are going to look at the most important chapter of economic survey from prelim standpoint. We are looking at the chapter of monetary policy transmission and the importance of RBI's monetary policy tools and the usual issue of liquidity and how it will impact the markets. All right. So this is the chapter here, monetary management and financial intermediation. In today's class, we will be just looking at the first half of the chapter, namely monetary management. All right. In tomorrow's class, in this week, we'll have Thursday, Friday, and Saturday, 3 days. So in tomorrow's class, we'll be looking at the second half of our chapter here. And in this entire exercise, we'll be looking at the prelim standpoint, what questions can we expect in this area. So first things first, let's first read the summary here, and then I will go back to the basics, link it to this context, and see how questions can be asked. All right. So India's monetary and financial sectors have exhibited robust performance, underpinned by strategic policy actions, etc., etc. Finally, let's come to the issue of capital formation. Capital formation has particularly been robust in primary equity markets. Household financial savings have increased towards equities and mutual funds with the share of equity-linked instruments. Basically, what is the long story here and how can we simply sum it up? Let's try to understand that by going back to our GDP formula. What is the GDP formula? C plus I plus G plus X minus M. You all know this formula. We have studied it multiple times. So if an economy has to grow, you basically need investment in our economy. We all know this. What is the link between this investment and banking sector? Or I would rather say entire monetary policy. The second factor, X minus M and G, these parts and also the consumption are mainly a product of one, our fiscal policy, and two, trade policy. So is it safe to say that our economic growth is a function of fiscal policy, monetary policy, and trade policy? Okay, this is the policy aspect of it. Apart from this, you have to supply some raw materials to the economy. These are the factors of production, namely land, labor, capital, enterprise, or the whole idea of how to run a business very efficiently. So these are the factors, the raw materials, these are the policy aspects, and in this present chapter, we are looking at what will trigger an increase in investments in our economy purely from a monetary policy standpoint first, and later through other means of financial intermediation. Okay, let's try to understand from the basics part, then we will go back to our survey. So what is the survey saying? Even though there is global turmoil, geopolitical tensions are there, we will be beginning again at the introduction of our economic survey. What did the survey say? There is geopolitical tension, right? And as a result, we planned for a certain amount of growth that didn't happen. We have lesser growth than anticipated, but we are still doing better than many other economies. And economic survey says that this is because of some policy decisions, namely GST, opening up the power sector for nuclear power through the Shanti Act, then some other measures that we have discussed in the first chapter. What are those measures? Go back to that lecture and have a look at it once again. Coming to this specific chapter of monetary policy transmission and how it will impact the investments, let's try to understand the various policy instruments we have. I'll just give you a gist and just brush up the basics once again. let's go back to our central bank, which is RBI, and the various policy tools that are available at its disposal. Consider this like a quick revision. Okay? Interest rate. We are talking basically about the interest rate. So when you want to talk about the interest rate, you have to consider two things. Mainly, it is the inflation in the economy. And secondly, it is about the current account deficit. What are the two metrics important? Inflation and two, current account deficit. Let's try to understand the implication of each of these metrics. And what are this basically? Inflation. Let's try to understand the concept of inflation first. Quick revision, okay? I know you must be knowing all these parts, but if there are people who don't understand this, I'm just giving you a quick background. In economy, there are two sides. One should produce something and the other one should buy something. Supply side, demand side. Okay? Supply and demand. When will an economy grow? When supply is equal to demand, there is no incentive for figuring out where will the extra money come from. So, if let's say for example, if there is 10 kg of onion that is demanded by 10 people, okay, and you are going to fetch 10 rupees for this, do you think the farmers will have extra incentive in a scenario where all the other conditions are constant? Let's say there is uniform rainfall, every market condition and geographical condition is same. Do you think they will produce 100 kgs without that demand? Even if they do that, this price will become 1 rupee. So, inflation is not a bad thing. Inflation is like motivation. There is some gap between the market and what is the supply. Only then the market will keep up. But what if there is a scenario that the gap increases drastically because of some supply side constraint? Imagine there is a monsoon failure or some flood. The production in the market came down. The product came down. The available quantity came down to just 1 kg. But demand is not changing. The same 10 people are searching for this. So obviously the price will increase, right? This is the basic concept of inflation. When there is a supply and demand mismatch. There is another scenario also. When new addition comes into the demand side, there is a new demand. Let's say real estate. Take the case of Hyderabad market, for example. In the outskirts, initially there were only 10 people and suddenly there is a buzz. A new IT park is coming up, or Google is setting up a campus, Amazon is setting up a data center. There is a buzz and there is a boom. People from elsewhere, they're flocking to Hyderabad to start investing in Hyderabad. The same available land will now automatically increase its price, like the realtor will increase the price. This is the inflation from demand side. Two different aspects, demand side and supply side. Clear? So, when you are talking about inflation and interest rate, it is a factor of inflation. Sorry, interest rate is a factor of inflation. The second aspect is current account deficit. What is current account deficit? Any idea? Let's say there are two countries. I will, for the sake of our conversation, keep it very simple and straightforward. India and US. US, you have your cousin, and in India, you are here waiting for your cousin to get you an iPhone, for example. Okay? Now, it so happens that the cousin is not sending anything to the US, but from there you are continuously getting iPhones. There will be an imbalance, right? Simply put, that is nothing but the current account deficit, where on one hand there is a asymmetrical shift of goods, and on the other you are not trading as much. Okay? So we run a current account deficit in terms of goods. In terms of services, like say IT companies, you are having a surplus because we are delivering services a lot. But when it comes to goods, we are not buying things from US that much, which creates a deficit. Now, in this scenario, what happens? You are continuously increasing the difference in how much we are buying and how much we are selling. When this rises, it so happens that rupee becomes less valuable. Okay, so what was 60 rupees for $1 now is 92 rupees per $1. Why is this happening? Partially because of the trade imbalance created by policies. Let's say our favorite character, POTUS Trump, is there. So he creates that trade imbalance time and again. The second aspect, which has been structural in nature, is that we are depending on foreign money, foreign goods, and everything that originates from the West, which will obviously have a cost. So continuously when the demand is rising and we are not developing capabilities within our country, what happens? Price increases or rupee value comes down. When this happens, if a foreign investor is supposed to invest in India, someone came in 2010 and they'll be like, okay, 60 rupees, right? I'll give you 60 rupees. I'll give you $1, basically. They'll give in dollars. So I have to show a return of $1.5 at least. Some 50% at least, if the return is there, I'll be happy as a businessman. So let's imagine that person went to coma and woke up today. The cost is 92 rupees. So if there is a contract saying that the price will be 60 rupees only, well and good. If Indian businessman is smart enough to say that I will repay in rupees. So essentially in 2010 he took 60 rupees. Today if he is giving 60 rupees, he is getting less than $1. It's a bad bargain for investors, right? So if you want to demand money as a borrowing from a US investor will be like, see, I don't trust your economy. You give me higher interest. It is very much possible that tomorrow this will touch 100 rupees and you come back and say, I'll pay in rupees. I'll be at loss. I would rather park that interest in my US bank account. At least it will not penalize me. I'd at least get 0.5% or 0%. At least I won't go into negative. So pay me a higher interest. Right? This is what they will say. This is how interest rates will be determined by domestic factors as well as international factors. Current account deficit and inflation. Clear? Am I saying that inflation will not be impacted by international trade? Obviously not. In a country like India, where structurally our energy needs are met through oil, which is imported from Gulf, 85% of our energy needs. Obviously, that is also dealt in dollars. Again, the current account deficit will increase. So it's a multiplier effect. In that kind of an environment, if an investor should invest in a country like India, you should generate more returns. So when you are saying that I want to increase my I component, you realize that there's little leverage that we have. Unless and until we shift the structure of our economy, we start moving away from, let's say, crude oil, or moving away from this burgeoning current account deficit, it is unlikely that we will sustain this level of interest for a very long time. On the top of that, you also have policy shocks like how Trump is doing right now. It makes financial maneuvering very difficult, not just for RBI, but also the governments. in this kind of a scenario, what should be the long-term strategy? One is diversity, but before that, Atmanirbhar Bharat, Make in India. So right from the day one, when NDA government came into picture, 2014 say, they were speaking of Make in India. Fair enough. Why Make in India? See, you might think that why am I teaching all this? This is not a part of the survey. They're of course linked to the survey part. Every chapter builds on the previous context, previous year's context, and the concepts there in survey are basically the static concepts discussed through the current affair lens. So you need to have a clarity on the basics. What are the sectors of economy? Primary, secondary, and tertiary. Okay. When you're talking about the share of these respective sectors in our economy, or to simplify further, if we are earning 100 rupees through these three sectors, what is the rough estimate of the contribution of each of the sectors? It's roughly 15 to 20%, 50 to 60%, and whatever is remaining is in this sector, broadly speaking. There is little that we can do in the services sector, because how many jobs can service sector create? Agriculture is anyway overcrowded. 45% of the population is depending on them, and there is the concept of disguised unemployment. What else are we left with? Obviously, the secondary sector. So from 2014, we were talking about Make in India, because when you are making in India, current account deficit will come down. We won't import unnecessary stuff. We would rather produce them in our own country and reduce that deficit. That is one. Second advantage is it will create jobs. Third advantage is it will create certainty in our economy, which will further improve our credit ratings. This concept of credit rating is very important, and to simplify what this credit rating is, let's try to simplify it through the analogy of a movie review. Okay, imagine on the same day there are two movies that released. Okay, one movie got a rave review, like people are praising it a lot. Other movie is supposed to be a multi-starrer, but it is boring. Which movie is more likely to attract audience in the long term? The first one. Content is the king, and any day you will see longevity for this smaller movie. You might have a bumper opening for this multi-starrer, but the content is bad, it will fall flat. Right. Similarly, when a country shows a lot of promise but is under delivering, you would require the investors, the country would require to convince a lot. Like you have to give a lot of incentives for investors to come into our country. As opposed to a small country which is delivering low returns, but it is creating a stable return. What is the global average economic growth rate? Nothing more than 3%. Take the trend. US economy is also roughly around that, even lesser. As opposed to that, India is offering 7%, 8%. China consistently for almost 2 decades delivered 8%, 9% growth rates, even 10% in a few years. So, if I as an investor has excess funds that I can move across the world, I would definitely want to park my funds in a country like India, provided that 7% growth rate is consistent across many years. The problem is it is not. So many things should work together for an economy like India to consistently generate that 7% return. For example, we should have a good monsoon. That's not in our control. We should move away from the global markets. That is not in our control, because something happens in US San Francisco, a new app comes up which can kill the software industry instantly. A case to the point being Claude. One app, ChatGPT, instantly reduced the freelancer writers for examples. That's a thing, that's a profession. Even now you will have freelance writers because you still need someone to prompt it and give me the final output. But the number of people depending on that sector significantly reduces. Right? So that is also a structural problem for Indian economy, services sector. What are we left with? Manufacturing. What is the problem of manufacturing? Go back to factors of production. Land acquisition is a problem. Labor loss and skilled labor is a problem. Capital, who will invest such high amount of money in manufacturing sector? Why? Because one, you have corruption. Two, land acquisition is a problem. If you try to do something, three, you have no capital. Banks are not giving you money. Fourth, enterprising ability itself, like the culture of business in India is looked down upon. When social, economic, policy factors are working against you, what is the maneuvering room you have? Very little. And this is the challenge faced by RBI, Finance Ministry. It's easy to make a comment, but try convincing your own parents to start a business. From, let's say you're having a job which pays you like 2-3 lakhs a month. Say that I will quit my job and start a business. Imagine how would they react? How many families are actually supportive of that idea? Because you shouldn't blame them as well. They grew up in a generation where they saw extreme poverty. They want good things for their kids. Having said that, times are changing. We have a generation that is not averse to risk now. So you have a young crowd that is willing to take more risk, who is demanding a better quality of life, better accountability from governments. So the only thing that will work in our favor right now is the demography. So you cannot reduce C plus GDP growth to C plus I plus G plus X minus M. Where will I come from? It will come from consumption. Consumption of what? What the next generation thinks is worth spending money on. What the next set of governments will think it is worth spending money on. And that money should create new assets. It should not dole out freebies so that the next generation will continue to become lazy. Alright, so this is the context in which RBI is playing the game. Clear? We understood the concept of interest and how it is linked to inflation and current account deficit. This is what the concept is relevant here. This concept is relevant here. What is the survey saying? Let's have a look. Capital formation has been particularly robust in primary equity markets. Household finance savings increased, shifted towards equities, mutual funds, with the share of equity-linked instruments in annual household savings rising, reflecting the deepening financialization of the domestic savings. What did you understand by this statement or this paragraph? Let me explain this with an example. Now, imagine a family in 1990. If the head of the family is earning, let's say, 10,000 rupees. You spend 2,000 rupees and save 8. When you say save 8,000, where is that money going? Usually, 99% of the cases, it is banks. And in banks, how is it parked? Through two instruments, broadly speaking, recurring deposits and fixed deposits. Okay. So let me explain the concept of financial intermediation and how it is relevant for our economy. The same person X opens a bank account in SBI, after getting a salary and says, SBI, please store my 8,000 rupees. I will take it after 1 year, fixed deposit. Okay. So this SBI is now having a room of 1 year. So I will give, if I am SBI, I will give a loan to a person Y who is willing to start a business. So the role of a financial intermediary is to create new opportunities for growth in our economy. This is the concept of credit creation. Now, why will this person take a loan? Obviously to start a business. What are the factors of production? Land, labor, capital, enterprise. Without capital, you can't start a business. So this person took a loan. Now, while taking this loan, SBI will say, boss, I'm giving you a loan. Why should I give you a loan? I want to earn some money. So give me 10% interest. This person will be like, okay, I will give you. Now, out of this 8,000 into how much? 800 rupees is the interest. This is the income earned by SBI by using this person X. Now, don't you feel it's unfair if this person is not getting a share, because basically it's his money, and obviously he can't expect everything. Without SBI, he won't get anything, and majority of the work is done by SBI. So SBI will take more and give less to this person. So this person is going to get a fixed deposit rate of, let's say, 5%. So 400, 400. They will share equally, or let's say 4% proportionately, whatever is the percentage. This is the concept of credit creation and the role of financial intermediaries in our economy. If I ask you, what is the role of financial intermediaries? It is credit creation and augmenting economic growth. Clear? So if something happens to the banking sector, everything will collapse. If you are someone who is just entering into financial markets and you want to make some money in the long term without being greedy, the first area in a healthy economy you should be investing is banks. Pick up the top 3 banks which are there in the Nifty 50. What is Nifty 50? The top 50 companies of our market. Within that you will definitely have banks, because without banks economy won't function. And if the health of that bank is bad, consider Indian economy is in a bad shape. Right? So many years ago, 2012, 13, 14, we were talking about the concept of NPA. Right? What is NPA? Non-performing asset. Why is loan an asset to the bank? What is an asset? Is loan an asset for you? Is loan an asset or a liability? Liability. For a bank, is it an asset? Right. Because it is earning interest. And if that asset is not functioning because people are not paying the loan, essentially it becomes a non-performing asset. So this is what happened in 2008 in US markets. There, imagine a bank like Lehman Brothers. They gave loans at a very low cost to people who did not have the capacity to pay back. So what happened? These Ys took many home loans, real estate market. And real estate companies were safe. They were selling homes left, right and center. Even if you need it or not, they were selling it. So what happened after a point of time? Circulation of money stopped. If I have to pay back a loan, I should generate some income. I lost my job. I have a house loan. I have 3 houses, and the bank is coming to me and they'll say that, I'll take away your house. I don't have the money and I'm not really interested in keeping it. You will be like, okay, go take it. That's exactly what they did. SBI will now come and capture all the houses. And essentially you will sit with the inventory of houses where on the supply side you are having large number of houses, but there is no one to buy because everybody is broke. This is called the subprime crisis, the global financial crisis of 2008. even though it is called a global financial crisis, majorly it impacted Europe and US. At that point of time, the level of integration of Indian market with US market is relatively low. So we were kind of cushioned from the global shock. If that kind of a thing happens today, we will be exposed very badly because the level of globalization increased. If that is not the case, you wouldn't be disturbed by the geopolitical tensions elsewhere if it were like in 2008. Understood? So it is a given that Indian economy depends heavily on global instruments, foreign finance, foreign money. Clear? The context is clear, everybody? Now, what is happening in this context? What is the role of foreign finance? What is the role of households? How will it impact investment? Let's try to understand. Now, when you're talking about foreign finance, how will it enter India? What are the two different routes? FDI, FPI. These are basics. FDI, FPI. What is the meaning of each of these terms? FDI, FPI. Or if you don't want to know the meaning, etc., and go into the technicalities of it, at least tell me the implication of presence of FPIs in this market. Basically, foreign portfolio investors are those people who are interested in making quick money, short-term thinking. They are not really interested in sitting for a 15-20-year-old period and then expect some 50-60% returns. They are not like Indian households. They want to invest today. Let's say, for example, they invest like 1 lakh crores. In a span of 1 month, they are expecting 5% return. That's a huge sum, right? So they have the ability to shake the markets. Apart from these fellows, in the post-COVID era, you are witnessing the rise of so-called retail investors or households like you and I. So you have households or retail investors in the markets. Indian economy traditionally depended on FPIs because we were offering a interest rate of 7-8%. These people were interested in us. FDI in India is a difficult task traditionally, from 2000 I'm talking about, or let's say from 1991 till 2026. In the last 30-35 years, why was it difficult for foreign companies to invest in India? Even after LPG reforms, there was an element of skepticism of foreign companies. Foreign power and control is still looked down upon in Indian economy. The socialist flavor that we had took some time to wane off. It is only in the last 20 years we have seen an increase in investment as a percentage of GDP, with a peak somewhere in 2007-6-7. In 100 rupees, 30 to 35 rupees came in the form of investments around this time period. And that is not because of policy, because everywhere else the companies did not generate enough returns. After this 2020 crisis, we are trying our best to attract FDI. But only a few companies are able to attract it, primarily because of the global uncertainty. Now, imagine an investor, like say if you want to start a business. Let's try to make it even more relatable. Let's say you are in Ashok Nagar and you want to start a food business. Would you do it if you come to know that UPSC and TSPSC may or may not give a notification next year? No, right? The market here is contingent on exam cycles. When your business is dependent on something so volatile, as an investor, I would be rechecking again. I'll be like, I'll wait and watch. Let me see what happens. This is the context of the present economic situation in India. There is a funding winter because of the global uncertainty. People don't know which direction the market is moving. On the top of it, you have technologies like AI. In a country which generates 60 rupees out of the 100 rupees from the service sector, and out of that service sector, IT services contribute nearly 40 to 45 rupees. A technology like AI will have earth-shattering impact to the households. If they don't have income, where will they buy all the goods from? Where will C come from? Consumption come from? Obviously, it should come from government expenditure. But that government expenditure cannot breach the FRBM limit or the deficit limits. You realize how difficult the time is now? So, if we have to grow in the future, there is no other way except to invest in capital expenditure for the government. And where will this capital go? What are the growth sectors? That itself is a confusion now. We are yet to figure out. Of course, healthcare, of course, education, all of this is fine. But what will be the impact of AI is not clear yet. The economies are divided on these lines. On one hand, in the foreign soil, let's say the same stock market in US is witnessing an inflation of funds in companies like Nvidia. The valuations are bloated because investors are betting big on this AI. What if that asset bubble breaks? What if Nvidia is not able to sustain that revenue? Every sector that is dependent on this will have a ripple effect. Money is limited. If I want to buy Nvidia stock, I will have to prioritize between two different stocks, either this or this, right? Or I can only bet on a few sectors. AI as a sector, people are betting, which means people are not betting on other sectors. So the growth in other sectors is limited. Now, if you are putting all your eggs in a single basket and that basket falls, what is the scenario? Other sectors can do well, but they don't have money. These sectors were expected to do well, but they didn't, and everybody is sitting without a cash. Does it mean AI will vanish? No. There will be a temporary period where people will struggle to figure out how to grow as an economy. AI will continue to do its job, but the reach will reduce. It is during that time period the gap between haves and have-nots will increase. So this is the doomsday scenario. What can happen in the worst case? The best case being how to navigate this challenge and make sure that the fruits of this technology are delivered even to the grassroots level. This should be the direction of our policy going forward. And it is exactly this economic survey is interested in. Okay. So here we will be talking about two different things, namely the qualitative tools and the quantitative tools in our monetary policy. What is a monetary policy first of all? Monetary policy. Basically, money is not supposed to be unlimited. A government, let's go back to the social contract, the political theory. Between an individual and the state, an individual will surrender some aspects of his life to the state in return for safety. As a bit to protect that safety, one aspect is financial safety or economic safety. Okay. So when you can create that financial safety, there is an element of predictability. Human beings do not like uncertainty. Do you like to be continuously under this uncertainty of UPSC? No, right? That is why you're continuously working. Similarly, banks, every financial intermediary will continue to work in a similar way for your financial safety. Okay. So as a part of this, you have a basis called repo rate. This repo rate is our policy rate. What do I mean by this? Let's say there is a committee called the Monetary Policy Committee, which will meet from time to time, look at the market scenario and say that, see, if money supply is very high in our economy, inflation will rise. We will make sure that we will increase the interest rate so that money is pulled out of the market. And if it is the other way, we will reduce so that there is more money in the market. This is the basis of our monetary policy. Okay. The basic rate is repo rate. Now let's try to understand how this monetary policy committee's rate will be used by RBI. RBI will try to create some policy instruments using this repo rate as the basis. So let's talk about the short-term direction. Here you have to know about something called the policy corridor. This policy corridor is nothing but the range in which RBI's scope will be there, and the basis for functioning will be this repo rate. Okay. So if, let's say, for example, this basis, let's call it X. If X is the repo rate, the upper end of the spectrum, marginal standing facility, is one end and the other one is SDF, standing deposit facility. I hope you know these basics. Okay. So when repo rate is announced by the Monetary Policy Committee, RBI will say, I will now change my policy rate of MSF to X plus something. Let's say A% or X plus 0.25%, 0.5%, whatever is the appropriate thing according to them. And this will be X minus 0.25 or 0.5 or 0.75, whatever it is. These are the two ends of the spectrum which you need to know. Together, these are called the quantitative or qualitative. What is the difference between quantity and quality? Quantity indicates the volume. Quality dictates the direction. Is this telling you the direction? It is for the entire economy. Therefore, it is about quantitative tools. The volume of money that an economy should have so that inflation doesn't disturb our life. Clear? What is this MSF? Let's say you are a bank and in a short term, when I say short term, 0 to 14 days. Okay. In that window, as a bank, if I'm not having money supply, I gave to some entrepreneur, I gave to Vijay Mallya, for example. I have to arrange funds immediately. Vijay Mallya will be like, I'll give the money, let me come back. So we don't know when that is going to happen. But you who is depositing that money regularly, very disciplined way, suddenly you got a need and you want to take that money out. You will have to pay to that sincere fellow. You don't have the money, that cash is sitting with Vijay Mallya. Where will you run? Obviously, you will go back to RBI and ask, boss, I have a small cash need. Please pay me some money. I'll pay you some interest. What is that interest rate? The rate at which you will borrow as a part of that facility, it is called marginal standing facility. Imagine the vice versa. I have excess funds, but there is no one to take. Then I want to park that money with RBI and generate some income. Obviously, it will be less than the repo rate. Why is it less than repo rate? If you can earn more money by putting money with RBI, what is the incentive for bankers to work? They'll obviously be very lazy. I'll go and deposit in RBI and sleep. Why would I want to go and find Vijay Mallya? Isn't it easy? That's the reason they will penalize if you park your funds in RBI. You have to go figure out an eligible person to take that loan. That is how market functions. Right? This is the qualitative aspect of it, the basics part. What about the quantitative aspect? Qualitative, the second half. Qualitative indicates the direction. For example, if a certain sector, let's say in American economy, most of the money is now flowing towards AI and they're betting big on AI. What if the scenario of 2008 crisis repeats? The so-called asset bubble bursts. It will have a ripple impact. To avoid this kind of scenario, RBI says, let's say if we have 1 lakh crores in the market, a sector cannot get more than some X amount of money. Okay? That is one kind of a control. Second kind of a control is you have some vulnerable sections. You can say, please give loans to them, moral suasion. That is one form of control. Another form of control is, let's say you have a gold instrument, which is costing today 1 lakh, for example. You want a loan. You must have bought it at 10,000, but today's rate is 1 lakh. Will you go to a bank and say, give me 1 lakh? No. They'll be like, I will fix a rate which is set by RBI. That is called the loan to value ratio, LTV. Okay. So if you give me 100 gold worth 1 lakh, I will probably give you 60,000 or 80,000, whatever is the market rate that day. This indicates how much money is flowing into what sector so that concentration of wealth doesn't happen. This is the beauty of RBI's design. These are the basics, quantitative, qualitative. Okay. What is economic survey talking about this monetary policy transmission? To understand this, you have to know one more concept called velocity of money or broad money and narrow money concept. We are discussing the basics, right? So I'm telling you that concept also. Imagine how RBI is going to manage such crisis. Like when huge crisis comes up, there should be some buffer. Before you even think of buffer, if you are starting as a country today and you say we are starting a new economy, how do you think a central bank will print money? Will they decide like, okay, let's arbitrarily print some 1 lakh crores and let's start the economy? Is that how it works? No. Every single rupee that you print should be balanced on the other side. If you create a balance sheet, asset, liability. For every asset that you are creating, there should be an equal liability too. That liability can be a gold, can be a government bond, or anything that that particular country deems fit. And it is the responsibility of that central bank to manage it. Okay. So when you are starting out, there is something called M0. What is this M0, M1, M2? You can go back to your basics. We are basically talking about the creation of money, the base. I'm not going to further elaborate on M1, M2, M3. I hope you know what is M3, which is the currency in circulation. Total money that is available in the market. Okay. So in this context, economic survey spoke about something very interesting. RBI reduced the policy rate. So obviously what should happen? Economy should boom. But that didn't happen because there is no demand. It did one more thing. There is a concept called CRR, cash reserve ratio. Are you going to get any interest on it? It is meant for financial safety. If you have 100 rupees on the bank side, a part of it should be kept aside. Let's say 4%. 4 rupees should be kept aside so that in the event of something bad happening, you will take out that 4 rupees and fix that issue. This is one layer. So at this point, RBI decided that if we allow CRR to be high, money flow in the market will reduce even further. So they reduced it even further. So this created a scenario where liquidity in the market increased. Okay, this is what the survey is saying. In UPSC, in terms of monetary policy, velocity of money, CAD, inflation, all these aspects that we discussed today are very, very important. So, if you read the text given here, you will have a lot of information. But I'm not going to explain all that because it is not really important. But you will have to know this graph. MO, M1, M2, M3, what is the impact, the trends therein. Read this chapter, and tomorrow we will be discussing the second half of financial intermediation. I will again explain this clearly to you. I don't want to overload you with all this information in a single day. Quickly brush up your economics basics on monetary policy, banking sector, RBI policy tools. Brush up the basics so that you come back with a fresh mind tomorrow. All right. That's it for the day. Thank you. Is there any confusion in the class today? Is it too much or the pace is okay? Fine. Thank you.
అయిపోయింది